Hello everyone, welcome again to Hybrid Accounts. Today we're going to study a new international accounting standard called IAS 12, income taxes. We simply abbreviate it as tax here, but it's actually IAS 12 income taxes. Right. What is all about income taxes? Usually when you do prepare our income statements, the companies would be charged the tax by the government, right? Yes. So we learn on how to get that right. But also, when you are charged the taxes, there are expenses which will be allowed for tax purpose and that which will not be allowed. But also for the income, there are those which will be allowed, and those which will not be allowed for what? For income taxes. So the problem here comes that uh, there is a financial accounting issue against the tax authority issue, right? So we speak here of financial reporting versus tax authorities. Tax what? Tax authorities. So that difference makes us have to do this, right? Okay, so we'll see the groups of income taxes and all. So let's just get some time and see what we can do. All right, so that's why if you look at this, we say upon completion, you would have to understand how to apply the recognition and measurement of current and deferred tax liabilities, but also to apply treatment of deferred taxation on a business combination. Okay, so simply speaking, it is that just to have a clue, we'll be discussing two types of taxes. The current tax, no, the current tax is that tax for the current period, right? The current what? Tax component, but also we'll speak of something called the deferred tax component. Deferred. Hope you know the meaning of what? Of deferred, right? If you defer something, it means that its implications are in the future, right? So you see, current is for the current period, deferred, it will be reflected in the future. And for both current and deferred components, you would have respective tax assets and liabilities, right? For the deferred tax assets and liabilities, this one will be in the future. And so this standard is very well against the conceptual framework because it's by the conceptual framework, it says that assets should be the present economic resources and liabilities should be the present obligation. But these ones are deferred. So deferred tax assets and deferred tax liabilities go against the normal concept of the conceptual framework, but actually the International Accounting Standard and IFRS would usually override the conceptual framework. Okay, so that's all. And now I can go on here, and go on here and start our principles now. Okay, let's start with the basic principles and then we'll only do this current tax, after which we'll go to deferred tax, right? So as I told you, we're dealing with the IAS 12 income taxes. Now let's see by words what current tax is and deferred tax is, but I think I've already explained. So current tax, the amount of tax payable to the authorities, not necessarily payable, it could be payable or recoverable, right? But usually tax has to be paid, right? It's recoverable maybe when you paid more than what you should have paid, right? Okay, so it's the amount of tax payable to tax authorities in relation to the trading activities of the current one period. This is just normal. What about deferred tax now? This is a part that is very necessary in this study. Deferred tax, as the word deferred itself says, it is an accounting measure used to match the tax effects of transactions with the accounting treatment. You see now the tax effect with the accounting what? Treatment. So it is not a tax that is levied by the government actually, that needs to be paid, right? But simply an application of the accruals concept. So as far as the tax that has to be paid, we apply the normal principles, but we just need to apply, as you see, the accruals concept, and they would see what we mean by that, right? Okay, so we can do it this way. In summary, you're told here the tax expense of an entity is calculated as follows, okay? You can just see this, but you're going to understand what really happens, not just following the pro forma, right? The tax expense should be equal to the current tax. Then you plus or minus the movement in deferred tax. Don't worry about this. You're going to get this very well. So just a formula, but you have to understand what happens, right? Formulas are useless if you don't know what happens, because what matters is after studying, what remains in your head is what will count, right? So you can count just the pro formas. Okay, let's go the current tax phase now. Accounting for current tax. Okay, the current tax is what? Let me tell you one thing now. This is what usually happens, right? For the current tax, estimations are usually made before the year end, right? For example, in our country, Tanzania, we say that estimations should have been made at the end, by the end of the first quarter of the year, right? So you estimate the tax liability for the entire year, but at the end of the first quarter, but you have the chance to keep revising as you see the different results compared to what you expected, right? So this is what we're going to do. So initially, we would have uh, unexpected tax, right? Not the real one, what you expect. So you will first, okay, I'm expecting this, or maybe I expect to pay $100 million, right? In tax. That one becomes an expense. So you debit the tax expense. That's what? Expense in the income statement, statement of profit or loss here, let's say 100, and then you go on and credit the current tax liability. Current what? This is the liability now. Current tax liability with the same amount of 100, right? And something like that, right? Yes. All right. In case maybe you expected to have the tax recoverable, you expect to recover the tax, not paying, right? You could do it the reverse way now. This one would be the tax. This one would be the. It would mean that I would be having not the current tax liability again, right? And here, not the tax expense. The tax liability would be the asset now, right? So I would debit current current tax recoverable, which is an asset by over 100. And down here, I would come and say credit now is an income, right? If you're recovering the tax, then it's like kind of an income. So I would say credit is kind of tax income now, right? Which is 102. This is what we do. But usually, this second case is usually very rare. So let's focus on the first double entry, right? So for the first one, we have an expense and the liability. For the second one, we have the asset in the statement of financial position and the income in the statement of profit or loss, right? But now this is what happens. Of course, I could explain it right away, but we're going to see it, right? This is just an estimation, a provisional liability. It may be or it may not be the case, right? So maybe by the end of the year, and maybe, for example, an account by the end of the year, you can have 6 more months to actually prepare the final account, right? But by the end of the year, you would be able to know the actual tax that you should have paid. Now you can see, you say, okay, I say that I'm going to pay 100 and I recorded it in my books, but the actual tax now, the actual tax is how much? Say, oh, my actual tax is actually 120. You say, oh, so I didn't do well, right? I'm saying that I recorded a liability of 100, but actually I should have recorded a liability of 120. So what am I going to do? Remember that in your books, you already have entered these entries, right? Yes. You already be having these entries. So what you're going to say is, oh, so my liability was supposed to be 120, but I only put it at 100, right? Okay, so since this is the actual tax, it means you're going to pay, right? You're going to pay this tax. What happens when you do pay? We credit the cash, right? Cash for the bank. So I'm saying that I'll credit my bank for 120, but remember in the books, I only have the liability of 100. I'm paying 120, but I'm going to settle this 100. So this 100 is going to get off my account, right? So I'm going to delete that liability. And so I would say debit that current tax liability. Current what? Current tax liability. At how much? At 100, right? Because I'm just going to write that off. So you have the balancing figure because actually it should have been 120. That balancing figure should be on the debit because credit exceeds debit by 20. So you come and say debit again. And what is this for now? We provided 100 is a provisional tax, but it ended up being 120. So we underprovided, right? So we call this an under provision. Under what? Under provision of how much? Of 20. How is this treated? Under provision is just treated in this way. Remember that we have already adjusted the liabilities. It's not 100 now, it's now 120, right? Okay. I hope you see that. It's 120. What about the income now? About the tax expense. It was 100. So this 20 means that it is going to be added to my tax expense, which I initially wrongly recorded at 100, right? So this is what we are going to do right here. Okay, so you can obviously see when you have an under provision, you go and add it to your tax expense. And so in case you have an over provision, it means that let's say maybe I said that I expect to have a tax liability of 140, so I should have recorded this, but I ended up having to pay just 120. So I would say the same thing. I would splash out the cash of 120, but I would cancel my liability of 140 now, not 100, 140, and you'll see what happens. Right now, the debit exceeds the credit, right? The debit exceeds the what? The credit. So say, okay, so I would have to come on the credit side and add something, which is 20. The difference is 20 here. Now you see, this 20, we call it an over what? Provision. You over provided. So you charge yourself income tax, which is very much higher at 140 instead of 120. So I'm saying that I have to go on and reduce it by 20. So when you have an over provision, you go and deduct it from your tax expense. When you have an under provision, you go and add it to your tax expense. That's all about the current tax computation, right? Okay, I hope you got that, and then let's proceed. So here we have the current tax, as you see, I've shown you, and let's go down. The current tax accounting is often based on estimates. As I told you, it's provisional, right? On estimates. And the final amount payable, the final amount is what I told you, the actual might not be finalized until after the financial statements have been authorized for issue, yes. And now, if the eventual amount paid is less, it means less means that I overestimated, right? I overprovided. It is less than the estimate. It means I would have overprovided. In the current period financial statement, then this will reduce the current tax expense. That's why I told you an over provision will have to reduce, right? And in case maybe the tax paid is more than the estimate recognized, it means if we pay more than what we estimated, it means we underprovided. Then we would say, okay, we underprovided. And so we showed that our income tax expense is lower than what it should have been. So I just need to go back and add it, right? And pile it up, right? Yeah, so that's what we actually need to do, right? So this one is under provision, so you go on and add it to the tax expense. You can usually see this maybe in the trial balance if it has been given. If not given, then you'll be given directly, right? So you have to know what happens. So you should with the entries you should know on current tax. If the first one, record the provision amount. The second one, when you do pay, know the over or under provision and make the appropriate adjustment, just like that. All right, now we are on basic principles of deferred tax. Wait. I think if there is a way, we should do an example on current tax. Wait a bit. I need us to go somewhere and do an example on this current tax, right? Of course, I think we should also do this. It's kind of, they have tried to avoid this, thinking that maybe you should ultimately know it. But, this comes from F7 financial reporting. And I think it's very important that I also explain it with an example, right? So let's not proceed with deferred tax. Let's go to the example of current tax. All right, you can see this one. Let's go and see how we make such entries, right? It's very, very essential for you. You can just let it be. You see these under over provisions, I will either explain it to you, and under provision will be added to the tax charge, and over provision will be deducted from the tax charge. Let's look at an example now. That's what I need us to do, right? And I also told you that you would obviously see like an under provision was on the debit side. In the trial balance, you would see that one, and you would have to add, the debit balance means an expense, while a credit balance for over provisions means income. So that's why it's deducted from the what? The tax expense. Let's look at this example here. Simple has estimated that its income tax liability for the year ended 31st December 2028 is this one. This is the estimated liability. But now, this is for the current period, right? So for the current period, you would say, okay, if you decided to record in the books, this is what you would have done, right? You would have done this way. I would have said, okay, I expect to pay 180 for this period. So I would say a debit tax expense, tax expense, tax expense in the statement of profit or loss at how much? The statement of profit or loss at how much? At 180, right? And then credit current tax liability in the statement of financial position at 180 again. That's what I would have done, right? Okay. But now let's read further explanation. In the previous year, the income tax liability had been estimated is 150. You see now, previously we estimated at 150. Required now, calculate the tax expense that will be shown in the statement of profit or loss for the year ended 31st December 2026 for this current year, for which the income tax before any adjustment seems to be 180. If the amount that was actually agreed and settled with the tax authorities in respect of 2027 was this one, you see now. So for the previous year, the tax was estimated at 150. But what was actually paid was 165, you see. So we underestimated, we underprovided. We said that we should pay 150, but we ended up paying 165. So it seemed that we underestimated. Instead of writing 165, we wrote 160. So we had an under provision of 165 minus 150. So for part A, I would say that I had an under provision of how much? 165 minus 150, which is 15. This is an under provision. And so to get the actual tax liability for current period, this is what should have been done, right? We would say the tax expense now is 180 for this period, but we would have to add that 15 so as to get the actual tax expense. So simply speaking, the error made in 1 year is taken forward and affect the next year, right? While for part B here, we would say we expected to pay 150, but we ended up paying less, which is 140. So I have over provided. So we have an over provision here, which is 150 minus 140 is 10, and so we can pay deducted here, right? So we say 180 minus 10 gives us 170, just like that, right? Ndio maana nimejifungia bana, mambo yamekuwa mengi. Nilifunga kule nikaja kufungua huku. Hali ilikuwa mbaya. Na nyinyi mlikuwa mnasikia matatizo asubuhi eh? Okay. All right, so that's all about the current tax. You have seen that now, and now it's time maybe we go further. You see 195 there, and then 170, and now maybe you can go to the deferred tax concepts now, right? Okay, now let's switch the books. Let's switch the books and go to this one here. Okay, now let's go to the deferred tax, starting with the basic principles of deferred what? Or deferred tax, right? Okay, so the main point in deferred tax here is that we focus on timing. We focus on what? On timing. Something is done today, or maybe let me give an example of depreciation. That one is a very good example, right? Let me show you something here. Let's say you have an asset which has different depreciation rates for tax purpose and for accounting purpose. For tax purpose, let's say you have the, let's presume that maybe you have the we have the book values, right? Or the carrying amounts. The carrying what? The carrying amounts depending on by how much the asset has been depreciated. For accounting purpose, let's say you have 100, then it depreciates, let's say by 20% each year. So next year it will be 80, next year 60, next year 40, and the last year should be 0, right? Now, for tax purpose, we call it tax base. It's just a different name, right? For accounting purpose, we call it carrying amount, while for tax purpose, we call it tax base. Let's say for the tax purpose, it goes this way. You start with 100 as usual, but this 100 changes to not 80. Maybe it goes to 70, and then it goes to 55. Then let's say it goes to 50, right? And maybe lastly it goes to 0. You see these differences now. So the differences in carrying amounts reflect differences in depreciation rates. And depreciation rates changes, it means the profit for accounting purpose would be different to the profit for tax purpose. But it is temporary because at the end of the day, all over 100 is going to be depreciated using either the accounting rate or the tax authority rate. So it's just a temporary difference. So whatever difference, which is just temporary due to timing, would be expected to result into deferred taxes, right? While for permanent differences, it wouldn't be the case. For example, let's say someone has not done good with the government, the company has been fined. Those fines won't have to be implicated. They won't have to reduce the tax expense, right? You say that you break the rules, you break regulations of the government, they charge you fines, and then you say, oh, this is my expense, it's deductible. That one is not a deductible expense, meaning that it won't help you in reducing the tax expense, right? Yes. So the permanent differences will leave them as they are, but the temporary differences are, we consider them for tax purpose, right? And for deferred taxes, right? Okay, so that's why you can see here, we say differences between the principles in accounting standards and the tax rules in particular are the ones which would mean that the accounting profits will not be the same with taxable profits, just like I told you. And some of these differences are temporary. It is temporary differences which we focus on. The permanent differences, it means that the difference is there and it won't change. It will be there indefinitely, right? So we don't consider them for tax purpose. Let's look at an example. PPE, property, plant, and equipment, might be written down at different rates for tax purpose than in the financial statements. I show you that example. So an example of depreciation is one. Provisions might not be allowable for tax until the expenditure is incurred, right? There are such things, right? For tax purpose, they may say that, okay, you have a provision in the books, but we don't care. We don't take it until actually the expenditure is actually being incurred, but are recognized in the financial statement. So you see, in the financial statement, they recognize the provision as a liability and they record an expense, right? That expense will reduce the tax, will reduce the profit. So the accounting profit will be different with the taxable profit because for tax purpose, it won't be allowed. But in due time, when the expenditure is actually incurred, the same thing will be done, right? So you can see this. And some of the differences are not temporary, which means they are permanent. If they are permanent now, they won't result in deferred taxes. For example, we speak of fines. Yeah, fines are expensed to the statement of profit or loss, but are normally disallowed by the tax authorities. There are no more fines maybe in business activities. Maybe you have delayed, a supplier has charged you, There are those which occur in the normal course of the business, right? But there are those ones which, let's say, the government charges you. So you won't be able to put them when deciding the tax liability is for tax authorities, right? But also, let's say client entertaining costs are usually expensed, the statement of profit or loss, but are normally disallowed with the tax authorities. So the temporary differences may mean that the profits are reported in the financial statements before they are taxable by the what? By the authorities. So simply putting it is that the temporary differences are the ones which would result in what? In deferred tax. So you see here a temporary difference is the difference between the carrying amount of one asset. Now you get my point, right? When you do compute these temporary differences and deferred taxes, we do not base on the items in the income statement, but we base on the items in the statement of financial position, right? That's why you can see we speak of an asset or a liability, right? If you also saw the previous example I showed you, and I told you that you had something, I spoke of the asset, but I put the carrying amount instead of depreciation, right? It's not like it is not possible to deal with that, but this way actually is the newly adapted approach, and it is very useful. You just need to understand how it is applied, right? Okay, so we say this happens due to the difference between the carrying amount. Carrying amount, we mean of one asset or liability. Tax base is also the carrying amount, but this is the term used when dealing with the tax authorities, right? So what is the tax base? You are told it is an amount attributed to an asset or liability for tax purpose. It is simply the carrying amount name for tax purpose, right? Okay. So we may go on and see an example here. Okay, let's see. You're told here, let's just look at an illustration and see how this is applied, right? Prudent prepares financial statements to 31st December each year. Okay, this is fine. On 1st January 2024, the entity purchased a non-current asset for $1.6 million, right? That had an anticipated useful life of 4 years. Okay, this is fine. This asset qualified for immediate tax relief of 100% of the cost of the asset. You see now, the tax purpose allow for 100%. So it's like you charge all of the assets is depreciation in the first year. You see, while for accounting purpose, you would normally follow the accounting principle that the asset has a useful for 4 years. You would need to depreciate the depreciation there, let's say for straight line because it's not specified, right? Okay, let's proceed now. We're told for the year ending 31st December 2024, the draft account showed a profit before tax of $2 million. You see, this is what it showed, profit before what? Tax. But obviously after deducting depreciation, right? The directors anticipate that this level of profit will be maintained for the foreseeable future. Okay, so we expect to have this same profit over the years, right? 2 million each year. And prudent pays tax at the rate of 30%. This is the tax rate given here. And apart from the differences caused by the purchase of the non-current asset in 2024, there are no other differences between accounting profit and taxable profit. So the only difference in profits would be due to the purchase of these assets, right? Which seem to have different depreciation rates. Okay, now what are we required to do here? We are required to compute the pre and post-tax profits for prudent for each of the 4 years ending 31st December 2024 to 2023. Okay, so for all the 4 years, inclusive and for the period as a whole, assuming that no deferred tax is recognized, and second, deferred tax is recognized. So for the first one, we are told that we disregard deferred tax, but for the second, we consider deferred tax. So for the first one, it's just normal because we just follow the normal current tax, right? So if we do follow the normal current tax, this is what we're going to do, right? How do you get the tax? The tax liability is usually obtained this way. Remember, we had the accounting profit of 2 million, and we are told that it would be the same for the foreseeable future. So first year, second year, third year, fourth year. This is just the total, so no problem. Now, as it is known, when you have the income statement with the revenues and expenses, right? So incomes and what? Expenses. We usually deduct this to get the profit. But for tax purpose, you have to come to the income statement and adjust, right? There are incomes which should not be taken, should not be recorded here. We remove them, and there are expenses which are disallowable. So you have to eliminate them, right? And this is what we're going to do now. When computing the tax, the profit, the taxable profit, the profit for tax purpose, not for accounting purpose, we should always remove the disallowable expenses, right? And that's why here we speak that the main difference is due to this asset which has depreciation, and so we have to eliminate the depreciation, the accounting depreciation right now, right? And so as you see, we have to add back the depreciation, right? Okay, so what we need to know is how we obtain this depreciation. We have a depreciation of 400. How did we get that? We need to go on and fix that, right? How did we get that depreciation of ours? With this, let's go on and get that depreciation of ours. Let's see the information given. We are told that the entity purchased a non-current asset for 1.6. So we know depreciation in straight line. If not given, you use the straight line method. You say it's a cost, which is 1.6 million, minus the residual value, not given, so we presume it to be nil, divided by the useful life, which is 4. So 1.6 over 4 equals to 0.4 million, right? Okay, so 0.4 million is what has been taken as depreciation here. We just 0.4 million means 400,000, right? So you have put the 30 above here, so you have the depreciation of 400. That's why you see we add back then the disallowed expenses 400, 400, 400, and 400. And then you get this one. And now we deduct the actual depreciation for tax purpose, right? So you can see we remove 400, which is not what we should. Remember, initially we deducted it. So we add back, meaning that we eliminate it, right? Because remember, we are adjusting this profit. This profit has been affected by all the items above it. And so the accounting depreciation was deducted to get this profit. So we add it back to eliminate it, and then we deduct the actual depreciation for tax purpose, which is 1.6 million. How did we get that? We are given such information right here. We are told this asset here qualified for immediate tax relief of 100% of the cost of the asset. So for tax purpose, we claim 100% of it. So 100% times 1.6, we still get 1.6, and that's why you have it here, right? So we deduct it. So if you see, you get the picture. Now you see this plus this plus this plus this is 1.6. Right? Like you saw here, you see, it's the same with this one, but now just the way, the timing, they are different, right? The amounts are reflected in different years. Okay, the total figure is also here. So you adjust now 2,000 plus 400 minus 1,600, you get 800 here, 2,400 here, 2,400 here, and 2,400, the total of which is this one. You get now. So to get the current tax, this is now the way of computing the current tax if not given directly, right? So you take the 30%, we are told tax equals 30%. So 30% of the taxable profit, 30% times 800 is 240, 30% times 400 is 720, 20% on 400, 720, 720 again, and you add them all to get this figure here, right? This is what we get finally. So you can see how they just differ over the years, but the total is 400, which if you took the 30% of this total profit, even before adjustment, you would still get the same figure of 24. See, 30% of this one, multiply this by 30%. You can get the picture by 30%. You are going to get exactly the same figure. So this is what I was trying to speak about, right? Okay, so that way you would be done on getting the current tax, right? Okay, so maybe in case now we need this, we had the profit before tax, which is 2,000 for each year. Now we would only consider the current tax liability, and so this should be the current tax expense. So we had this for year 1, year 2, year 3, and the year 4, and this one is the total, right? So we go on deducting and get the profit after tax, right? But for deferred tax now, you would have to consider both the current tax and deferred tax, right? So ignoring the deferred tax, we could see that we produce a performance profile that suggests the declining performance. You see the way it would seem. So although I see that I had 2000, 2000, 2000, and 2000 here, you get the point now, the meaning of deferred tax, right? Although we got exactly the same profit since we had the same depreciation, but since for tax purpose, we put the whole depreciation in the first year, the profit seemed like to be declining. You see this one, it goes falling on falling and falling, right? So we need to make this adjustment, right? Now we go on and apply the deferred tax concept and see how the profits would be. You could just see before doing anything, just come down here and see the profit on deferred tax. Look, for deferred tax, profit after tax, you see, we have the same figure. So this is what we do as an intention of dealing with deferred what? Deferred taxes. I hope you can see. It is the same profit after tax. So that's why we consider deferred tax for this purpose. I hope now you have got my point, right? Yes, this is the main aim. That's why you have got something like this. So I hope everything will be fine from now onwards. All right. Now let's go back at the requirement and then come back to finish up with this concept of hours. Okay. Here. Now you are told, assuming that deferred tax is recognized. Now let's go on and recognize the deferred tax and accomplish this task, right? Okay, so for deferred tax purpose now, like I told you, to know the deferred tax, you need to compare the carrying amount and the tax base of the net assets. Of the net what? Net assets. You know, by net assets, I mean assets minus liabilities. Assets minus what? Minus liabilities. So you may take the net of assets and liabilities and compare them, or you may take assets alone and liabilities alone and then combine them. But actually, here we are only provided with assets. So you only focus on what? On assets, right? Okay, so you have the carrying amount of an asset and the tax base, right? Carrying amount is just the normal one, right? Remember that we had 1.6 million in the carrying amount. If the cost incurred at the beginning of the year, and we had the depreciation, we had this one in the initial cost, but we had the depreciation of 400 each year, right? So carrying amount for accounting purpose after 1 year, we would say this one minus 400, you would get this one. Minus 400 for the second year, you get this one. Minus 400 for the third year, this one. Minus 400 for the fourth year, we would have nil. For tax purpose now, for tax purpose, we are told that we have the depreciation at 100%. So just at the first year, we are going to deduct all of 1,600. It is all going to be deducted, right? That's why at the end of the first year, you have nil. Second year, nil. Third year, nil. And fourth year, what? Nil. Then you take the difference, carrying amount and tax base. If you deduct, you get this one minus this one is 1,200. 800 minus nil, 800, 400, and nil here, right? So now what you are going to do, you take a 30% of this figure. 30% of this figure would give you what? Now get my point. When the carrying amount of the tax base when the carrying amount of an asset exceeds, or of net assets exceed the tax base of net assets, you are going to have the deferred tax liability. Why? Look here. If this carrying amount here is greater than the tax base, it means less depreciation was deducted than in the accounting books than for the tax purpose. If less depreciation was deducted, it means we still had more profit, right? For the accounting purpose, right? So to compensate for that, we would have to put the deferred tax the liability right here, right? So simply speaking, when the carrying amount of the net assets exceed the tax base, carrying amount of net assets exceed the what? The tax base, actually I would have a deferred tax liability. When it is less than, I would have a deferred tax asset, right? So not the sign. That's why if you are only provided with liabilities, you can put the negative sign on the liabilities so that you get this concept, right? That's why I focus on the concept of net assets and I'm not just saying assets as a whole, because we usually consider as net what? Assets. So if you have liabilities and zero assets, then you would have to say 0 minus liability, then you would be having a negative figure here, right? So 30% of this one to 1,200, you get this one, then this one, and lastly, you have this figure here, right? So now Okay, this is just a way of showing, but I could give you another concept, but it's no problem. You can take it as a closing liability if they have paid, right? Then to get the opening now, you know, the closing liability becomes the opening for the next period. So this 360 would be the opening for the second period. This 240 would be the next opening for the second period. 120 would be for this period, and this nil would go here, right? But also here, we had nothing. So that's why the opening for this, there was no closing in the previous years. That's why I put here nil. But it's no big deal, you know. Maybe we just need to get what we should charge the statement of profit or loss. It's easy. Just do it this way. This is a liability. This way they have done, they just deduct this one minus this one minus this one, and they get the other concepts here, right? But it's easy. Do it this way. Right, the way they have done, if it is positive, you say it's a charge, it's an expense. If negative, you say it's a credit, so it's an income. But we can do it this way. Look, this is the liability. The liability now, and this one gives you the figure for the statement of financial position. You have the liability of 360, but it came from what? Initially, we had 0. So from 0 to 360, so all of this would be the expense. That's why it's here. Okay, if you come here, we say that our new liability is 240. But previously, we had a liability of 360. So our liability has fallen by 120. A liability falling means an income. That's why you say you'd have the income or the credit here. And here we have 120, but previously we had 240. So the liability has also fallen by 120 when we have another income. And lastly, we have nothing here on liability, but initially have 120. So we say we claim again. So we have these charges to the statement of profit or loss, right? Okay, now if you come down here, prepare your statements now. You had this the profits. The current tax, you computed it in the first place. You had the income tax expense based on deferred tax concept for all the year 360, 120, 120, and 120 here. And now you can get my point now, right? I told you 360 was an expense. Do not just look at these signs. You know, if you look at these signs, you would say, okay, why was this positive and that has been put as negative? This is an expense, right? Because you initially didn't have a liability, but now you have a liability of 360. So a liability increasing only means that you had an expense, right? So this one should be an expense, while this one should be the income, right? So you come and see them here. This one should be an expense, and this one should be the incomes, and that's why you see them as positive here. So just combine our figures now. 2,000 minus 240 minus 360, you had this figure. And here 2,000 minus 720 plus 120, you had this figure here. You can see how the profits have been smoothed over the years now, right? So by including the deferred tax implications, to try to balance the mismatch between accounting and tax profits, you find that you have these profits here. And now I get the concept. Presume maybe you took your original profit at 2,000, right? Deduct a tax of 30%. 30% of 2,000 would be 600. 2,000 minus 600, you would get 1,400. You see? The final profit would be the same. Nevertheless, it wouldn't matter. It would be the what? The same, right? But now you wouldn't be able to know how much comes from the current tax effects and how much comes from the deferred tax what? Effects. So it shows you how deferred tax helps. A more meaningful performance profile is presented, right? Initially, you had 2,000, and so even after deducting tax, you should have had the same profit after tax, and you see they are the same 1,400, right? Well, in case you came up here, you would find the profits different. This one falling, and this one is the highest one, and this one they are the lowest, right? So I hope you got the concept on the current tax and actually including the deferred tax now, right? Okay, so maybe it's time to dwell more on the deferred tax and deferred tax now. We'll leave alone the current tax and put our focus just on deferred taxes, right? So you can see further examples of temporal differences, which would result with the impact like you have seen above here. Let's say temporal differences should include, but they are not restricted to the following. These are just examples. Whatever happens temporarily would be expected to result in deferred tax implications, right? tax deductions of items of property, plant, and equipment that have a different pattern to the write-off of the asset, like you have seen there, right? Depreciation rates different, but maybe intragroup profits in inventory. We are speaking of consolidated financial statements here now. Intragroup profits in inventory that are unrealized for consolidation purpose. So it's something we call provision for unrealized profit. Let's say what a parent has sold goods to the subsidiary, but at the end of the period, some of the goods the subsidiary bought have not yet been sold out of the group. So since consolidated groups, we mean that we combine the results of the parent and subsidiary. It's like the group has attempted to sell to itself. So that profit that remains on those goods that have not been sold is what we call unrealized profit, right? And that one is usually subjected to temporal differences and thus deferred taxes, right? So we're going to see that. Okay, another example, losses reported to the financial statements, but the related tax relief is only available by carry forward against future taxable profits. That one is also another example. We'll actually see the examples by practice. Assets are revalued upwards in the financial statements, but no adjustment is made for tax purpose. You see the revaluation. Let's say like I-16, we have I-38, we have the investment properties I-40. You can do the revaluation of assets. The assets are taken up, but that revaluation gain is not charged, right? It has to be charged. Because although for tax purpose, you won't consider it until the asset maybe is disposed, but ultimately upon disposal, it will have to be reflected. Development costs are capitalized. You know, when we speak of I-38 intangible assets, we have research and development. And if the cost is termed as development cost, we say that it meets the criteria. It may meet the criteria for being capitalized, although not necessary. It will depend on whether the criteria have been met, right? For which usually based on something called higher rate. We look on probability of economic benefits. We look on a lot of matters, right? Intention to complete the asset, right? And use make it or sell it, reliable estimate of the asset, right? Availability of resources, the technical feasibility, and expectation of making a profit from development of that asset, right? So development costs are capitalized and amortized with profit or loss. You see that you're already amortizing it. If you do amortize it in the future periods, but we deducted for tax purpose as incurred. For the tax purpose, as it is incurred, it is deducted. But you know, when you do have it in your books, you amortize it. So there would still be temporary differences and you have to account for them, right? And lastly, we say the cost of granting share options to employees is recognized in profit or loss, but no tax deduction is obtained until the options are exercised. This now is for IFRS 2 share-based payment. We can also recognize the deferred tax implications on share-based payments. IFRS 2, you know, we usually have the grant date. And then we have the period people have to stay with the company to have these rights. And then we have the vesting date, the date at which they can exercise, right? So that one I think is very specific to the standards. So it's no big deal. Okay, now we are told, we are being given explanations on how to get temporal difference. I think we have done it already up there, right? That's how we get our temporary what? Differences. So deferred tax is calculated by comparing, as I told you, you compare the carrying amount against the tax base, right? Against the tax what? The tax base. And they told you of an asset or liability to its tax base, right? Tax base is also the carrying amount, but we focus on tax purpose, right? If something is not allowed for tax purpose, you don't include it. If it's allowed, you include it, right? Okay, so that's why I'm telling you, instead of saying assets separately and liability separately, you could say net assets. You could take the net assets minus what? Minus liabilities. I'm saying to take the net so as to make your matters easier, right? And as I told you, if the current carrying amount is greater, if the carrying amount of net assets or of the assets themselves is greater than the tax base, we have the deferred tax liability. If it is less, we have the deferred tax asset. But for the liability, it will be different. You know, the liability is deducted from net assets. So for the liability, if the carrying amount is greater, then we would say we have the deferred tax asset. And if it is If it is less, then I would say that we have the what? A liability. That's why I'm telling you again, you can just compute it in terms of net assets. Just take assets minus liabilities. If you have no assets, just say my asset is zero, and then the liability will have a negative sign. But it won't matter. You may just go and follow it this way, right? The tax base of an asset now is an amount. I've told you it's just the carrying amount for tax purpose. So it's an amount that will be deductible for tax purpose against any taxable economic benefit that will flow to an entity when it recovers the carrying amount of the asset. And so if those economic benefits will not be taxable, the tax base of the asset is equal to its carrying what? Its carrying amount. But also you can know the tax base of a liability, right? It is its carrying amount less any amount that will be deducted for tax purpose in future periods. In the case of revenue, which is received in advance, we are speaking of deferred income here, right? Let's say, for example, the tax base of the liability is its carrying amount less any amount of the revenue that will not be taxable in the future what? In the future periods. We're going to see this when you do apply the concepts. You know, deferred tax is the topic that when you do study, it may be a bit difficult for you to conceptualize, so you have to go with the examples and learn the practicalities of it, right? That's how its chronicles explode. Okay, now when looking at the difference between carrying amount and the tax base of an asset or liability, we say this one, right? If the carrying amount exceeds the tax base, the temporary difference is said to be taxable. And if it is taxable, it means that it would have a liability, right? We are speaking of the asset here. And the tax base, in case the tax base exceeds the carrying amount, then it will be deductible, right? So this is what you have to deal with. I hope you have seen, in case the carrying amount exceeds the tax base, the temporary difference is taxable and will give rise to a deferred tax liability. We are speaking of the assets because assets and liabilities cannot have the same implication, right? They should have said if the carrying amount of one asset exceeds the tax base of an asset, the temporary difference is taxable, right? You know, if the carrying amount of an asset exceeds the tax base, take an example of depreciation. It means we charge less depreciation for accounting purpose than for tax purpose. If we charge less depreciation, it means we have more income. If we have more income, it means we have to charge ourselves. Because why are we having more income than what we should have had? Charge ourselves more. And that's why you have what? A deferred tax liability. Right. In case this one, I'm repeating again, this statement is right for an asset, not for a liability. And this reverse is right for an asset again. For the liability, you reverse it, right? Yes, so you should note that very, very well. Okay, now let's look at this in the next video. Let's look on how to, I think we can something here. I think you could do something here still. How about you? All right, and the next video, we explain and we solve this question on how to get the carrying amount, the tax rate, but also the temporal difference, and being able to know whether there is a deferred tax liability or a deferred tax asset. Be with us. If you haven't subscribed, you can do that for regular updates. Thank you very much, and until next time.